Hey, hi everyone. Welcome to the liquidity panel. We have an excellent panel this year. I usually do this panel almost once a year, maybe twice a year, liquidity panel. And the amazing thing this time is that we usually have, because Finance Magnets doesn't have a liquidity panel in the US, we usually never get anyone from the US. But this time around, we have a majority of speakers who are US based, which is very important in the world of liquidity, of course, US being the biggest market in the world still. Although London is the biggest FX market in the world, New York is still one of the biggest in terms of liquidity provision. So I'm going to let everyone introduce themselves. I'm going to start with Laine, if that's okay.
That is fine. My name is Laine Litman. I work at Virtu Financial. I am our global head of FICC Liquidity, which is fixed income, FX, commodities, and crypto. Virtu is known for its global scale, competitive landscape, and transparent execution services. We have many different business units that work across multi-products.
Okay, Peter.
Hi, everybody. My name is Peter Durkin. I'm the CEO of Lucera. We provide connectivity on demand and software as a service across multiple assets, FX, fixed income, crypto.
And Jonathan?
Yeah, hi, I'm Jonathan Brewer. I'm the founding partner and commercial director of IS Prime Limited, part of the ISAM Capital Markets Group. We are one of the leading prime of primes in the market. I guess we're probably more focused at the retail broker end of the market than many of the other representatives on this panel. So hopefully we'll be able to give a sort of perspective from our end of the market.
Andrew?
Hi, I'm Drew Neve, formerly the founder and CEO of FICCC. Today, I'm owner and I run Trader Tools, and Trader Tools is a software company that sells basically trading software for regional banks and institutional brokers, and so that's where we come from.
That's great. Yeah, so it's a great panel. It's one of the most knowledgeable group of people I think I've had on my panels. So I was going to start with some general questions, but I'm going to skip that and go straight to a little bit more kind of technical screening. I want to go with what's happened during the year to date, essentially. What's happening in the market making side? What are you guys seeing? What's the big thing? I know there's been a lot of increase in fill rates, for example, or fill rate changes. So I just wanted to hear your comments on fill rates, how markets reacting. I have to say, generally speaking, I'm surprised we haven't had a massive issue in FX. FX spot kind of handled it better than I would have expected. I would have thought something huge would have happened by now. Maybe this means that everything's working as it should. But of course, there has been issues. Maybe you can highlight that as well. Laine, if we start with you, what do you think of the last 6 months?
Yeah, so I think overall the FX market handled the situation and the volatility pretty well. We obviously did see a massive spike in volatility and messaging updates from March 8th to March 24th. Since then, I'd say volatility and messaging has stabilized a bit. But what was really highlighted during that time, from our view as a market maker, the majority of our models do market making, was the need for market makers to be able to provide during different types of situations, whether the market is stable or volatile. We actually saw our market share rates jump quite a bit during that window of volatility, which kind of highlighted that a few people were backing out of the market and maybe didn't necessarily have the right collection of models to price no matter what the market situation was. We also, our fill rates were pretty stable, and where we noticed the greatest variance was both in if we were being traded over an ECN, if that ECN was in fact sending out real-time price updates, or if they were lighthousing the updates. and also the technology that the end user was trading on. If we did notice quite a few technologies had issues handling the message updates during the spikes and the sharp moves. And obviously fill rates during those specific times did fall because people were getting backlogged data or attempting to trade on stale market data. So I think what this time really highlighted is overall the FX market did operate pretty effectively for people who have a diverse group of market makers providing them liquidity, and for the market makers who have diverse models to provide liquidity. And it also highlighted the need for good technology, both at the venue level as well as the execution level.
Yeah, that's interesting, because I think as a liquidity provider, you can hear that sometimes people say, well, now we could see which technology providers were good and performing well. But I've heard that from from technology providers as well, where they go, well, during this crisis, I'm sure Peter would say that as well, where he will say, look, we could see which liquidity providers were good during this crisis as well. So it kind of goes both ways. So Peter, what could you see from your side as a technology provider?
Yeah, I mean, I think to echo what Laine said, I think there was a period in March 8th, 10th, 12th where the market data volumes really ratcheted up to extremely high levels, and I think overall, I think I was impressed with how the industry handled it. I think in the past you would have seen a more systemic issues throughout with respect to technology. Now there were isolated issues where you had people trading on stale rates, people not able to handle the microbursts and things like that. But I think in general, if you compare it to a couple of years ago, 5 years ago or so, I think the industry has invested in technology, and I think that was kind of proven very well over the course of the pandemic. I think it handled the volatility well. I think people did step out of the market, but the people that stayed in the market handled it very well. I think the platforms overall were generally good, and I think as a technology provider, it's encouraging to see that people are investing in technology and see that technology has a massive part to play in an orderly market, especially in times of volatility like this.
And fill rates, you didn't see anything stand out on fill rates, or did you see some stuff there?
I think there were a couple of examples where fill rates fell off. Again, after us looking at it and do the analysis, it was pretty clear it was due to technology. But again, I think the people that stayed in the market, the LPs that stayed in the market and were pricing, were giving two-way prices throughout, their technology was very solid. Their fill rates, kind of held up, and they were the ones that were helping the market remain orderly.
Yeah. Okay. Jonathan?
Yeah, I mean, I suppose we have two potentially relevant perspectives here. I mean, we obviously are quite a sizable consumer of liquidity, whereas obviously a lot of the guys on the panel are sort of either technology or providers of liquidity. But I'd echo what the two previous guys have said. I mean, I think there have definitely across the market been some technology challenges. We have obviously spikes in volatility lead to spikes in price updates. They're obviously very, very heavily correlated. And we've seen some technologies have struggled with it. Some have handled it very well. We haven't really had any problems on that side at all. I think from an LP perspective, some LPs have been a little bit risk off. Some LPs have definitely stepped up to the plate. So I would say we're probably at the minute experiencing a slightly narrower subset of LPs taking a higher percentage of our business. I guess the most hairy area of liquidity within our tier of the market during the coronavirus crisis, well, there have been three standout products. Oil, which I had a full head of hair before the recent oil crisis. Gold has had its liquidity challenges as well. I mean, both of those obviously being physical commodities have their own delivery characteristics, etc. And it's been on that side really where the challenges have come there. And then obviously Turkish lira in the recent month or so has been quite a severe headache. We've been fortunate enough to be able to continue pricing it, but which hasn't been the case across the board. So I think almost all three of those products are almost worth exploring in their own in their own right, but probably not enough time to cover them here. I suppose oil was the one that was most tangible for us. Obviously, oil going negative. Certain large US providers obviously put out some media about losing quite a lot of money on that particular move, and different providers in our space handled it in very different ways. Obviously, we worked to try and come up with a solution for our clients. A few of our peers did as well. A few of our peers completely remodeled their products to something that was less favorable product to the client, and some providers went on finance magnates conferences and carped about other providers coming up with gimmicks when they weren't providing anything themselves to their clients. So that was the oil thing specifically in our tier of the market was a very, very interesting story, which probably we'll be releasing some press on in the near future. But I would say, yeah, oil, gold, and Turkish lira have been the three most challenging individual products in the last probably 6 weeks to 2 months.
But did you see anything fill rates? Did you see anything specifically that stood out for you as well, or like that clients or technology is not behaving the way it should, or you see the whole period as pretty similar? So
I think with us, because a large percentage of our business is retail originated, albeit through retail brokers, so not to the direct retail end client. A lot of the orders that we receive tend to be market orders anyway. So actually, our fill rate is not far off 100%, which is a slightly misleading stat, because if you don't fill a market order, you've got a problem. So on the LP side, there's definitely we have noticed different fill rates between different LPs. I think the LPs that have focused more on, let's say, a no last look type of setup have probably struggled a little bit more. Obviously not in terms of fill rates, but obviously they've had to defend themselves in different ways by widening pricing and maybe slightly pulling back from the market. But in general, from our perspective, fill rates is we focus on it a lot street side, but really in terms of kind of fill rates out to clients, it's been pretty solid, but for slightly artificial reasons for us.
Great, thank you, Drew. And your thoughts on the fill rates, and also the next question we can move on to as well, which is which liquidity providers you think are struggling and not struggling.
I think I would echo a lot of what other people said, that the industry largely handled it well, but it wasn't really a good test, I would say, for the industry. This is not one of those S&B type things where the market disappeared. I think the market was generally very orderly in FX. This is when FX shines versus other asset classes because of 24-hour nature, right? Everybody just wishes we had more volatility in FX, not less. And it lasted longer than it did, right? I would say our advantage point is that we get to see lots of different types of clients and how their experience differs. And I would say, if you kind of broad stroke it, two different types of clients. One is regional banks, and largely who have very friendly order flow that they send their market makers. They generally tend to see, very high fill rates, a very good experience. They had, I would say, a really good, across the board, their clients didn't notice too much. I think that clients who had a much more difficult profile, that had much more, call it toxic, difficult order flow, institutional order flow, and they were basically brokering for larger, more sophisticated clients. Those obviously saw bigger challenges. Some are client specific, and I think that a mistake that people make in quiet times is that they, especially people who have difficult order flow, pile on lots of liquidity providers because it's difficult to get, different people to commit. And then obviously those people, they're in volatile times when update, rates go up, those become, it's actually better. It's counterintuitive, but in my 20 years of doing this as a consumer, and as a provider, it's always in volatile times better to have a smaller subset of providers, handle the volume. It's much easier for everybody involved, and it obviously keeps technology issues away, and it also keeps, it makes it easier and more profitable for the providers themselves, which is an incentive for those providers to stay in, right? Because obviously some providers are more cautious, than others. And it obviously depends on the venue, right? The easier your order flow, the more your, providers are going to be there. I think it's going to be, it very much depends on who the client was. Their experience very much varied.
Yeah. I actually think you brought up a really interesting point about how obviously some of the technologies did struggle when there were a lot of liquidity providers in the heavy time of updates. But your point that if people really kind of consolidate how many liquidity providers they work with, then, given the technology solutions that they may have, that's how they're going to have a better solution in the long run. But I think, what's really important to that is making sure that you have a diverse set if you do have a smaller number. Because if you have, let's say 5 banks that look exactly the same and trade similarly and price similarly, you're probably not going to have that great of a liquidity experience, even though your technology is able to handle the updates. But I think that was a good point about figuring out like what tools you have and the best path forward.
Right, and I think it's important that the liquidity that you do have is actually somewhat unique, right? Because I think in the industry there's a lot of recycling and kind of regurgitating, and the common phrase is kind of phantom liquidity, where you have all this liquidity, but at the end of the day it's kind of recycled. And for the most part, you should try to optimize your liquidity setup such that your diverse pool of liquidity providers are each providing a unique source of liquidity. And I think that's very important. And I think the industry has has made strides in that direction in recent years, and hopefully that will continue.
Yeah, I'd agree. I mean, I think at our tier of the market, you do, which is probably one of the most guilty in terms of, aggregating, re-aggregating, and going nuts. You see some providers who, in theory, grown-up institutional providers who talk about having 100 liquidity providers. Just like, okay, I have been doing this for a little while, and I probably couldn't name 20 serious liquidity providers. So yeah, I completely agree with the fact that one always likes disagreement on panels. But
I have to say, Jonathan, depends on the if you could have more than 20 liquidity providers. If you have a lot of different currency pairs, oil and CFDs, you could in theory say, look, I have 40 liquidity providers, but definitely you can't say that, I have 40 G7 liquidity providers.
Right.
I would say the one place where there's problems, and there's still an issue is EM currency. So about 35% of our volume on a Trader Tools on our clients goes through it's EM currencies, right? And I think it goes through a larger set of providers. And I think it is definitely where, even for benign order flow, even for people who have, been pretty good to their providers, this is where spreads widened the most. This is where slippage was pretty high for market orders. The miss rates were pretty high for limit orders. I think this was a very challenging. So I think we we need to not congratulate ourselves too much because COVID crisis was not really a G10 crisis from a FX perspective. If you look at other asset classes like mortgage-backed securities, there was like serious problems in those things. I don't think the financial services community passed this test with flying colors. And you can see the little bit of it you can see as you saw it, not just in Turkish lira, but even in South African rand and some of these other currencies. Spreads took a while to come back. Fill rates took a while to come back. And obviously there, the discrepancy between those who had decent order flow and those who were, had challenging order flow, obviously was much, much wider. So I would say this is, if people were to add, providers or need something, I think it's EM is where there's place for unique providers, because this is where the major liquidity providers struggle more, because they tend to be, Western-based institutions who do not have inventory, right, in Mexican peso and those type of things, and therefore don't have the same, weight. So I think that's still a real challenge in FX.
And I think also on the back of that point, what's important is so many people view their liquidity providers of what % of my overall market share are they? And that's how they determine, is this a good liquidity provider or not? Which, I don't want to tell anyone how to do their job, but I think that's the wrong way to look at this. As Drew exactly brought up, or as other people brought up, who was there during volatile times? Who still is filling me during volatile markets? Who's actually pricing me who's actually pricing me in crosses and EM? That, the crosses and EM pairs are never going to be as high a volume as euro, yen, sterling. But does that mean that people who are actually really valuable in EM and crosses are a less valuable liquidity provider? I don't think anyone could argue that. I want to say no one could argue that point. I'm sure there's someone out there who will.
Find someone to argue it.
Yes, I'm sure we can find someone, but I just don't think that is what people should necessarily just be focused on, is overall market share. Because then what is that next liquidity provider actually contributing to your overall liquidity?
Right. That's I think that's a very, very good point. And I think something else about that kind of, having multiple sources of liquidity is the differing execution workflows that some of your clients may have. So you can have specific LPs to cater to specific types of execution workflows, be it full amount, be it small tickets, things like that. So there's kind of a few different things to think about, but I definitely think that there's nuances there. But overall, I think there is in general, a smaller set of LPs in the market that are providing very good utility across the board.
So Jonathan, on that point, do you see that if we go specifically to banks, in your interaction with those banks, are you seeing larger banks control the market more? Is that a temporary thing? Are you seeing any of that, or not?
I think we've definitely seen that certain banks have fallen away a little bit. I think probably banks who've got more up-to-date infrastructure have probably done better, because obviously we've already talked about the technology challenges that there have been, and there are some banks that are operating on technology that's relatively antiquated. But we have definitely seen that there are certain LPs that have stepped up and certain LPs that have slightly fallen away. I mean, I think forming liquidity from third-party liquidity sources is very much kind of what we do. We have obviously clients for whom we're providing numerous different liquidity pools, and I think it very much is a sort of horses for courses approach, as the other guys have been saying. We have one broker client of ours might have 6 different liquidity or access to 6 different liquidity pools from us, which might be full amount, it might be small tickets batching, it might be an ECN liquidity feed, it might be all sorts of different setups. So I think Laine's exactly right in that there often isn't enough time spent on trying to work out exactly what value each individual liquidity provider is providing within which different segments. So, we have on occasion some order flow that appears from a client that we haven't had before, and there can be one particular LP that swallows up a lot of that flow and does very well on it, and becomes an LP that's 2 or 3 in our rankings for a given month, but then might be usually languishing at the bottom for the rest of the time. So we put a lot of effort into working out which LPs are adding value in which areas, and frankly, which LPs aren't really adding value in many areas, because we do try to keep the liquidity pool down to as few LPs as possible, because you really want to reward the ones that are actually contributing.
I think you have 2 trends in the market that kind of, only kept on going, I think, ever stronger in the last 10 years. One is obviously, everybody knows there's been a massive concentration in market share in banking, and that includes FX in a pretty big way, the top few banks. And obviously, even in the high frequency trading community, top few traders control most of the order flow, right? And I think that that's still the case, right? And only getting more and more concentrated. And I think that the other thing that's interesting is you have a pivot of a lot of people, and this is where users have to be more honest with themselves about their own order flow, is there's a lot of people who, as they've gained market share and become bigger, basically become pickier, right? And have said, I don't want certain types of order flow. I don't want certain types of things. And so people need to be very there are certain institutions that will price anyone, obviously differently. They'll price different types of clients differently, but they'll price anyone because they price ECNs and they price anonymous volume, all the time, right? And I think that's, kudos to Virtu. I think as an example.
I was going to say we aim to do that. I know there are people out there who say we will only price you if your profile looks like this between 30 and 60 seconds, which I don't think is actually healthy for the market. And as you said, it's important that we have different models that we're able to apply to the different way people consume. And, to some of the earlier points, people who are really good, consumers may not have a lot of providers are, sending their full order to someone. They obviously get the most competitive model. Someone who is probably even willing to acknowledge they are toxic, we still will price. They're just not going to get the same model that the really, friendly, soft counterparty is going to get.
You're going to get a lot of flow from me soon.
I think a lot of that is where, once people are making an honest assessment of themselves, right, and there's a lot of tools today to do that, they can basically filter out. There are some providers who are amazing for soft order flow and are dominant market share in that department, who are very picky, and if you are not fit within exact parameters of what they want, they'll kick you out, right? So it's just a waste of time for you to have. I think it's very user dependent.
Does that landscape, you'd expect it to change, because as banks take risk, and if new banks wake up, or something changes and they start taking risk, those banks that you were saying are comfortable or whatever, or getting big, and they might have to fight for this again. I think if more banks start taking risk, will we see a change in your view on this because of the risk taking at the banks?
So where, if you look at Western banks, basically have been under such an attack in the last 10 years by regulation, other, things like that, that they're basically, for the foreseeable future, they're moving in the other direction other than taking risk, right? So that's only been getting worse and worse. And I think that I wouldn't expect much of that to happen, right? And I think they're just getting smarter about profiling, about what they want. They're getting better tech, right? But they're not going to take higher risk. That hasn't happened yet. Where we see, so Trader Tools as an example sells a lot of technology to emerging market banks, and emerging market banks have a lot of appetite for risk, tend to have not been assaulted by regulators for the last 10 years, right? And to be closer to the government, depending on the country. And I think that, and because some of these countries only have 3 or 4 big banks that control the entire banking system, they're way more necessary, for that. And I think that what those banks really lack is really the tech and the size and the scale, right? But where I see that those, obviously they add value in their home currency, and I think that that's what we're gonna, we try to help them capitalize and distribute that to other, to other people, because that's where they're unique. But I think that if you look at banks in general, like Western banks in general, moving the opposite way of taking risk, and I would not be banking on those people, to do much of waking up, especially, if the financial crisis is any guide, as loan losses pile up, people retreat even more, because it's big institutions tend to have, even though the FX department did well in 2008, everybody else didn't, and the banks retreated away because the bank is a kind of a global, management looks at it with an eye towards the whole thing, and often doesn't even understand its own, difference between different instruments. And I think that that's the same today. If you look at, if loan losses pile up from, restaurants that can't open, et cetera, that's only going to make banks more cautious. And
Yeah, you gotta bank on the bank. So Peter, anything to add on the banks? Are you banking on the banks?
I mean, I think the banks are always going to be around, right? They do provide utility, they do provide liquidity. Are they as solid a liquidity provider as other participants in the market during times of stress? It really depends on the bank. I think with respect to risk, I think as everybody said, they are very cautious. However, their levels of internalization, I think, have increased. They've improved their technology. So I think they are able, beginning to be able to start pricing their clients more competitively and taking on more client flow. But I mean, I think they're not getting more control of the market. They're still there, and it remains to be seen how that will play out. But I think, the likes of the large non-bank LPs, again, we have seen that they are a pillar of the industry at the moment, and that they can provide orderly markets and will price you two-way prices throughout. And there are some banks that do that, but again, it's not as many.
If what you guys say that, we've got some big banks taking a lot of the business, and if they come under attack even more and they start sort of getting put off market making in even the majors, those top banks, how can we have even more fragmentation? Like, where will this go? If, Jonathan, what do you think? Like, if the biggest banks that we think are taking a lot of this G7 flow, let's say, or even other stuff, if they come under attack, and if it's going to go that way, where is this going to end? It's going to be even more fragmented.
I mean, it's hard to have to look into a crystal ball and see, whether the market is going to become kind of more fragmented than it currently is. I mean, I think there is a huge amount of recycling that goes on within the industry, and I think there are certain providers that, particularly in our tier of the market, that actually kind of actively encourage that and aren't necessarily too sympathetic to their LPs in terms of all the challenges of double hits and all the other associated issues that come with reaggregating and with fragmenting liquidity. I mean, I can't really sit here and say that I think fragmentation of liquidity is necessarily a particularly bad thing, because ultimately our clients face us rather than facing direct to the street. So to some extent, we are participants in the said fragmentation. But I suppose that puts some degree of responsibility on our shoulders to make sure that we interact with LPs in a sympathetic and a communicative way. I mean, I think that it's definitely the case that there are large subsets of the market that consumes foreign exchange that completely views liquidity providers as a utility, as something you can just kind of churn and burn, and they don't necessarily think beyond their sort of day-to-day actions. And so if we take the example of Virtu, we often have clients who come to us and say, well, you've got liquidity from Virtu, so does Prime ABC, so you're both the same, right? Well, that's from Laine's own mouth. She said that they will price anybody, but they'll price them according to the characteristics of their flow and the way that they behave. So I've slightly moved off the point of fragmentation, but I suppose to answer the question, we somewhat participate in the fragmentation of the industry, but that doesn't necessarily have to be a bad thing, because by the same token, we're providing credit access that other people don't have access to. So
right, and I think if you kind of look back at our earlier discussion around EM pairs and things like that, I think fragmentation of the market can be a necessary evil here, right? Because if you have multiple participants who are providing good liquidity in difficult currency pairs, then that fragmentation, you can say, okay, that's not too bad, right? Because then you have some of these stresses that are distributed across different LPs who are good at pricing these EM pairs. At the same time, you have different execution workflows, which you have, again, to say that, the full amount, small ticket, stuff like that. So that fragmentation, I think, is good. And as long as participants are, again, working within the global code and providing genuine, unique liquidity, it's not such a bad thing. And I think, there's different types of kind of fragmentation. And I think we have to be careful that we classify that.
I think also...
Sorry, I was just going to say, do you feel as though the banks have become more careful and more cognizant of what the recipients of their liquidity feeds are doing? So in terms of 100%. Kind of recycling and liquidity, etc. I mean, that's definitely something that we've observed. I mean, Citi obviously announced that there are lots of third-party providers that they're no longer going to price for that very reason. But that feels like a definite trend in this in the industry. That banks are much more careful about what their recipients are doing with their prices.
Well, I don't even think it's
liquidity providers.
Yes, I was going to say I don't even think it's just banks, because I actually know, with the last conference I think anyone in the FX market got to go to in February, I was talking to some other non-banks, and we actually all had identified one of the other non-banks that we'd kind of caught repricing our more competitive feeds through brokers, and we were unclear how they were getting our liquidity. But I think banks have become significantly more aware of what are you doing with our liquidity. We want to understand where it's going, how you're treating it, how you're trading on it. We're trading partners with a lot of banks, not particularly in spot, but in some other FX products, we will trade with banks. And a couple of years ago, we really kind of started the discussion with them of, this is who Virtu is, this is what we're doing with your liquidity. We want to be a fully open book, and you should expect this of all of your consumers. And it seems like, I don't want to say we started the trend, because some were already aware of that and starting to question it. But now everyone seems to wants to be aware of, who are you? What are you doing with my liquidity? And am I comfortable with my liquidity being handled that way? Now, the people who may not be concerned at all, what's doing with their liquidity and willing to put people on whatever stream and not necessarily have different tiers, like maybe it's not their own liquidity, so they aren't protecting it in the same way. And I think, there's lots of things that you can kind of take from these discussions and hopefully learn from, both as a liquidity consumer, a liquidity provider, even a prime. So.
Yeah, I mean, the trend is, like you said, fragmentation is going ahead. It's good for everyone, it seems. Otherwise, we'll have to go back to the banks, Jonathan, right? We just go back to the banks if it goes the other way.
I would say that there's also, people forget that not just FX, but in the last 10 years, treasuries, futures, even to a large extent, equities have really fragmented, right, into two separate markets, right? You have two parallel universes. So you have the people who price, venues like ECNs, right? And those things, and if you look at that market across all liquid asset classes, probably the top 8, 9 HFTs control 90% of all market making. You know, for that's how concentrated that business is, right? If you look, so the banks are actually they're usually market takers on those venues, you know, and generally not market makers on those venues at all. Where you look at where banks still dominate to a very large degree is the direct dealer, like dealer to client.
Yeah,
trading.
I think we actually do, as you said, we need to break it down to dealer to client and then maybe like dealer to dealer for the treasury world. Because there still is fragmentation in the sense that a lot of non-banks have a hard time reaching that true end consumer of the liquidity, and banks are potentially just consuming it in other asset classes.
Yeah, okay.
And I think the dealer to client segment still controlled by the banks, but as you know, people find, you know, credit intermediaries like Prime of Prime or other things into end users. I mean, that's that the non-banks have made a lot of inroads into the dealer to client, you know, space, you know, in the last few years.
That's a segment. That's where I'm struggling to see how they would be able to go and beat all the banks in their own game, you know, where there's so much the banks provide in terms of credit across asset classes, loans. There's so many things that it's just feels impossible for these non-banks to set up these massive desks that the banks have and just go and get all the dealers.
Well, I think on that point, there isn't necessarily, at least from Virtu, a desire we don't want to be a bank. We know there are certain things banks do and they do them really well. And we'd never be able to compete in that sense. So it doesn't make sense for us to target some of the businesses you mentioned. You know, is spot FX liquidity one of those markets where the banks, you know, will do it better than any non-bank ever can? No, and that's why I think you're starting to see a bit more of the dealer to client impact there from non-banks as well as the banks, and even some of the banks facilitating the non-bank trading with their customers.
At the risk of treading on slightly shaky ground, so I agree with you that obviously in spot FX, you know, it's well publicized that a lot of the non-banks are absolutely relevant liquidity providers. I don't think anybody would debate that, but the banks obviously do control access to the credit, so yes. Which makes it, I guess, somewhat challenging for non-banks to price. Just pick a random subset of clients, let's say real money, for example, because the banks still need to say, okay, non-bank ABCs can have a credit line with real money XYZ, and the banks, one could make a case that the banks do sort of jealously.
They definitely do control it. They definitely do control it, and you know, I don't even think necessarily credit's the only issue in reaching the end client. I think also you know, you mentioned asset managers. How many, you know, some of the banks even struggle with the allocation process of asset managers. And now you're having a non-bank go through a bank and attempt to do that same allocation process. It's a bit of a mess. You know, I talk very frequently with my colleague Ruben, who works on what's known as the broker neutral side of the Virtu business. And there, Triton is the EMS we have, and we're making it multi-asset to include FX so that their clients can trade at this point with their banks and, you know, their providers and spot swaps and forwards. But a very key component to that was making sure there was an allocation process in place for all of these asset managers, because, you know, asset managers depend so heavily on a couple technologies and the bank's current workflows to even be able to trade FX, period. So there's a lot of these dependencies that kind of are, I guess you could view as almost like roadblockers, both for asset managers to improve the technology that they're trading on, or improve the system that they're trading on, or improve the liquidity providers they're interacting with. And I think kind of as a market, those are also opportunities for us to identify the issue or the situation and attempt to present a solution for it.
Yeah, that's excellent. I think I'm going to move on quickly to the analytics part, which we should have also covered part of how, let's say, how when we trade with Laine, how can we make sure we don't make them too angry and we can analyze things both ways. And Peter, in terms of analytical tools, I mean, I've noticed it's become much easier to have conversations. You just don't get people shout at you as much, and you don't shout at people as much with those tools in play. And I know, Drew, you guys have some stuff too. So Peter, what's the latest there to help performance during this period?
Yeah,
and
I mean,
generally?
yeah, I mean, look, I think analytical tools have come a long way. I think it's the increasingly electronic nature of the business with increasing, numbers of market data updates and things like that makes having a capable analytics tool a cornerstone of any FX business, right? Because as you rightly point out, if your LP comes to you and say, look, this flow is very difficult for me to price, unless you have data to kind of argue your case, then you just have to accept it. So basically, you need the ability to quickly analyze the vast amounts of market data and do your TCA and do your markups and things like that. I guess the challenge is in FX is, well, how do I market, kind of what is the golden source of data? You can have many, you can have a very long conversations with people about that. But I think, without delving into that too much, I think it is extremely important to have these tools. And, I think technology has progressed sufficiently that they're part of everybody's toolkits. And I think it's just how far people have progressed and how they have incorporated these tools into their workflow. But, I think it's it's a massive part of the industry now, and I think it's only going to get bigger.
And I think also what was really interesting is during these volatile markets and the pandemic, again, as I mentioned, I talked to my colleague Ruben all the time, kind of we're talking more thematic issues across the FX market. We had a lot of banks and non-banks reach out at the start of April and say, like, I need to have a better understanding of, TCA, what I can present to my customers or what I can present to the banks that I trade with. And he saw a massive uptick in inquiries for people wanting to work with the Virtu analytics, which again is on the broker neutral side at the start of April, which, you think people would kind of be more focused just on, am I still, alive? Did I handle messaging? But people really wanted to dig down to the data and understand what they were seeing and if they in fact had the best data available to them.
Yeah.
Right. And I think it's, we always focus on TCA and things like that, but I think other things that people are starting to kind of look at is to look at the underlying market data and potentially identify where people are recycling, where people are kind of not they're not internalizing liquidity and things like that. And you can glean a lot of information from looking at correlations between LPs and things like that with their market data streams, and I think that's something that's starting. We talked about banks, having an idea of what you're doing with their liquidity, and I think they're starting to do those things as well, as they're starting to look at market data and where it appears and how it moves, with these various other LPs that you have on your platform. So I think that's something that's starting to creep into people's workflow. But again, I think that's going to be more commoditized over the course of the next couple of years.
Yeah, I think a lot of this is really just something that analytics has given people an opportunity to delve deeper than to say, this client's bad or this client's good, but to say, okay, this client's bad in these two currencies, but actually is fairly benign in these others, right? And I think that there's a much easier today to dissect stuff and say, okay, by currency pair, not just by currency pair, but even to say that at certain times or certain sizes of orders, like this client has decent profile in small orders, but his large orders are not so good. We see that with a lot of regional banks. So I think that those are things that analytics today give us a much deeper way to look at clients much easier, and it gives us a way to guide, the conversation between the client, the consumer, and the providers, a lot more. But some providers were able to adjust to the fact that to say, okay, I will adjust pricing for certain currency pairs, not for others. Some people are still in the no, player A is in the penalty box or player B is fantastic.
I think
right?
analytics is becoming so important, Jonathan, that I wanted to ask you on top of whatever you're going to say is that analytics is so important that I almost feel like it's so important that you cannot leave it even to the tech provider, perhaps. Maybe in 10 years, we'll be like, we need independent. I know there is a few already out there like TradeFeeder, et cetera, that are independent, saying we're not even part of the platform. So we can independently look at the platform performance and the liquidity provider and the client. So it's becoming a very important subject, the analytical tools.
So, yeah, so I mean, analytical tools are absolutely fundamental to what we do. I mean, essentially, we've got the poacher on one side, the gamekeeper on the other side, and we're trying to keep both sides happy. So, knowing what they're all doing is very, very important. It's kind of heartbreaking for us as a business to admit that analytics kind of off the shelf and that are provided by a lot of third-party tech companies have improved, because when we first launched our business, part of the benefit of being part of a buy-side business that obviously really looks at execution and really looks at analytics was on our first day when we arrived, I was showing the analytics tool and my eyes popped out my head. And we're in a relatively low sophistication end of the industry. And that was a massive advantage for us, and it still remains a massive advantage for us to have very detailed and very bespoke analytics. But it is the case that the market sort of has caught up and is much more aware of what's going on. I mean, I think the majority of our competitors couldn't even spell KDB before the last, maybe 6 to 12 months. But I mean, I'm sure there are probably other people on this call who would maybe disagree with you that on the subject of whether third-party technology providers have a role to play in analytics. We do it all ourselves, so we'd be on the proprietary rather than licensed side of the fence. But
we spent millions of dollars on that stuff, and I can just get it from Drew for nothing, right? I mean,
I'm sure that's what Drew would say. Yeah.
I think that to say that the analytics have gone a long way and are much more generic than they used to be, much more accurate than they used to be. Obviously, there's differences. I would say the market is long technology, right? It's just short honesty, okay? And that's still fundamentally still a big problem. I think it's not so much the tech today, but it's clients making the choice of saying, I have 3 different profiles of flow going through the same feed. It's largely good, but I sneak in the bad stuff, or do I dissect it into 3 different things to get much better prices for my benign clients and a little bit worse for the non-benign, or do I stick them all together and try to jam it all because overall that still works? And I can say, certain customers don't control it as much as people think. So I think a lot of this but there's a lot of choices and a lot of things in life. And I would say that of the people that do control it, most people it's not a question of they don't know, they're just not willing. Right?
Yeah, but I think to that point,
sorry.
I think the technology is starting to keep people honest, right? Because in the past, liquidity providers potentially didn't have the ability to kind of weed it out proactively and quickly, but now they do. So I think that's forcing honesty on the market, because very quickly, if you start sending good flow and then you start trying to put in the bad stuff into it, it's very quickly weeded out. And I think that's the good part of all of these analytics. I think it's making the market more honest.
Well, and I think also on the analytics front, what's important is there are still some people out there who are not honest or ask for certain last look windows, and then they do something 5 milliseconds after their last look window ends, and more liquidity providers are able to see what they're doing now. And I think there's honesty, and then there's omitting facts that now people are able to see. There's so many data points that before I think people could kind of hide behind, or they didn't necessarily, 1 or 2 providers may have been able to see, whereas now the vast majority is able to see what people are doing, and it is factual, and it's much harder to hide.
Yeah. Excellent. I mean, yeah, technology is going to be able to make us all honest. I love that. Peter said that, huh? We'll talk about it in 10 years and see how honest we've become in 10 years. But so we don't have that much time left. So I'm going to ask a couple of questions that people have asked me. One of them, I know Jonathan briefly discussed it, but we've got a question coming in about Turkish lira. I know you touched on it, Jonathan. Turkish lira, what's happening there? Like banks are shutting it down. It's like PBs are saying we don't want to trade it anymore. Laine, what's happening there? I mean, generally just from basics.
I mean, I think there was a lot, there wasn't, the full transparency from the regulators necessarily in Turkey that made it clear to banks what they were supposed to be doing, both from a trading desk perspective as well as a PB perspective. And so there was a lot of uncertainty of what people had to do to make sure they were being compliant with the requests out of the region. So I think, unfortunately, we don't know what's going to come out of that region next, what's going to be said, how people are necessarily going to interpret rules. But based on our interaction with, both the trading desks and the PBs, they're all working very diligently to make sure they understand, what is required of them, that they're taking into account the risks, and they're operating in the best capacity that they're able to with the information they currently have.
Okay. Anything else to add, guys, on Turkish lira?
I would say we have a whole bunch of Turkish banks as clients. And, obviously they've been dealing with all of this stuff, and I think this is going to happen a lot more in a lot of other currencies going forward, because I think the COVID crisis is going to hit emerging markets much harder than it's going to hit, Western markets, simply because emerging markets can't print the money that for example, we're printing in the US or Europe will be able to print to get out of this mess. And I think there's going to be more stuff like this. If you look at Turkish lira, one of the things is, a lot of countries, right, as the authoritarian regimes kind of clamp down, don't like negative research. Some people just got, it's as simple as people published research that says the lira is going to weaken, and the government doesn't like that and just said that's not allowed. People forget that in, I think it was 2015 or 14, there was like BNP had to take like 2 analysts out of Turkey, for doing that, right? Because they essentially violate national security law. I think that we're going to see that in China. We're going to see that, and when countries are doing well, they don't say a word about stuff like this, right? They understand it's financial research. It's benign. It's not meant to some political dig at the country. But when the country's, when the currency is heading towards an inflation rate that, steals bread out of people's mouths, right? I think that those governments get very sensitive and they just overreact. And I think that there is the more countries are in crisis, the more uncertainty you'll see around things that we don't expect. It's not something like the payment system collapsed in Turkey or there's any real substantive thing. I think it's really just these are reactions of governments, and I think we don't need to name names, but you're going to see that happen a lot, right? In numbers of countries, if those currencies get into an issue, there's going to be a lot more of that. And, finger pointing is ever more popular, right? To blame some external parties, always been, it's like a political across the board, distraction mechanism that everybody uses. And I think that's something the financial services sector has always.
Yeah. So speaking of the other question is about oil. So oil isn't tied to a political, well, it is political, but it wasn't like one country doing something, I would say. Maybe, some countries did some stuff, but oil going negative. And then one of the biggest platforms, MetaTrader, can't handle negative prices in oil. I couldn't register negative prices myself, but it went negative. And, it was panic, right? Everywhere. Jonathan, you guys, MT4, they couldn't go negative, right?
Well, I mean, I don't think one should necessarily single out MT4 as a technology platform that couldn't anticipate negative rates in an intrinsic product. So yeah, MT4 certainly couldn't handle it. Some of the bridge providers couldn't pass on negative rates. And really, I guess a lot of the concerns were sort of what were the second order conditions that might happen as a result of negative rates? What would it do to margin calculations? What would it do to P&L calculations? What would it do to etc. So obviously the interactive brokers press was one of the more extreme examples of it, but that was very definitely a risk that could have happened to really anybody that was providing oil liquidity. So we would lean heavily on the fact that there were lots of different reactions to that, and certain providers basically pushed all of the risk. Providers specifically in our space pushed all the risk onto their clients and said, "Well, we're just going to cut pricing. Good luck to you." And some other providers came up with some solutions. So it was obviously a relatively unique situation, and obviously the press has covered the reasons for it. But yeah, the situation within the market for people who were providing liquidity specifically to retail was hairy. That was probably the longest week of my career. It was interesting.
Yeah, Laine, you guys did anything in oil or?
So in our principal market making group, we do trade oil. I'll just say it was a very interesting week.
Okay. Yeah, I think others have had big numbers that will come out much later about this whole oil thing still. I don't know. And then it's funny. So there was a storage issue, and then 4 weeks later, it's up $60 compared to that. I mean, it's minus 30, and now it's plus 30. I mean, it's amazing.
Yeah. I think basically what it kind of just highlighted is the need for very strong risk systems. And, could anyone have really seen that going negative when they were building risk systems possibly years ago? I'm not going to say yes or no to that. But I think, we were very fortunate.
Have you built in negative rates for euro-dollar?
Oh, yeah. Yeah, we're covered. We're covered now.
Great. Okay. I think that's all we have time with, and time flies. So we could do a little bit more. I mean, it was a very interesting discussion, and we'll have another one, I'm sure, because, as Drew said, FX hasn't been tested yet properly. So we might have another panel in a few months where FX has been tested properly.
Uh-oh.
Maybe about Hong Kong. Maybe about the Hong Kong peg.
There's all sorts of things coming up. So
yeah.
Next one will be interesting, I believe, and we'll see. Maybe FX will be tested properly. Great.
I'm interested to hear what we think tested properly means, Drew.
Yeah.
That's the beauty about finance. Every 5 years, it's anybody's guess what it will be. Like it's
you know
hard.
when it's being tested. I think that's the way to say it.
But I think there's Europe. There's Hong Kong. I think, like Jonathan said, there's no shortage of potential scenarios, and God knows what they'll end up as being. But it's always been that the scenarios you most expect never happen, and the one you can't see coming, is the one that happens. And I think that's been the case. So who knows, when that's going to be.
Great. Okay. Thank you, everyone. Thanks for your time. And that's all we have time with for now. Great.
Thank you very much.
Thanks, everybody.
Thank you.
Thanks.
Thank
Bye.
Goodbye.